Return stacking. Borrowing against your own assets to rent alternative return streams to stack on top of them, in the hopes that those returns exceed, or at least provide benefit, greater than your borrowing costs. What could possibly go wrong? But before we get into what could, and has historically, gone wrong, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. So, what the heck is return stacking? Well, if you go by what Samuel Jeffrey says, it is a capital efficient investing strategy, and that's correct as far as it goes. And it is historically assets coming together like sine. Bleh. Yeah, I didn't think that the existing resources out there would satisfy a lot of people. So I made a deep dive video about return stacking. Anyway, before we talk about a single specific ticker or really get into the nitty gritty of this, I want you to sit with one frustrating truth about the portfolio you own right now. It is full. You have exactly 100% to work with, and every good idea you fall in love with, managed futures, gold, a trend sleeve, it has to elbow something else out of the way to get in, right? Want to add a diversifier? Great. So, what are you selling to pay for it? Your stocks? Your bonds? That trade off is the invisible tax on diversification, and it's the reason most people stay in a plain 60/40 or, just a lot of unlevered funds, even when they know better about diversification. Return stacking is the strategy built entirely around escaping that ceiling of 100%. So, let's unpack how it actually manages to pull that off, at least in some cases. Here's the basic idea. Instead of dividing your dollar, you stack on top of it. For every dollar you put in, you still get a full dollar of your core, your stocks, your bonds, the stuff you'd own anyway, right? And then layered on the top of that, you get a second dollar, or maybe 50 or 60 cents of something different. A trend following strategy. Gold, maybe. Carry, perhaps merger arbitrage. $1 in, $2 of exposure out. That is return stacking in a sentence. Now, if you've been around the investing world even just a little bit, your risk radar should be going off. Wait, that's leverage. Yes, it absolutely is. And we're going to be brutally honest about that later. But notice what problem it solves. You're no longer forced to choose between owning your core and owning a diversifier, right? You can own both. And this isn't some crypto era BS invention. Big institutions have ported returns like this for over 40 years. What's new is that it now comes in a cheap, one-click ETF accessible to retail investors. Gosh, I hope that doesn't go sideways. So let's demystify the magic. Step 1. You get your core exposure through futures. A futures contract on the S&P 500, for example, gives you the full return of the index while only tying up a slice of the cash as margin. Step 2. Because the futures already did the heavy lifting, most of your dollar is now free. And it doesn't sit idle. It sits in treasury bills, earning interest, acting as collateral. Step 3. You use that collateral to bolt on the diversifier, the managed futures sleeve, the gold, whatever the fund stacks. That's the whole engine. Now, leverage is never free. The cost here is essentially the short-term interest rate embedded in those futures contracts. When cash rates are high, that's a real headwind that has to be cleared. A concrete example here. The Return Stacked U.S. Stocks and Managed Futures ETF, ticker RSST, gives you $1 of the S&P 500 and $1 of a trend strategy in a single fund for about 1% a year, plus friction fees and the federal borrowing rate. The most direct lineup for these return stacked funds is none other than Return Stacked from Newfound and Resolve. RSST stacks stocks and managed futures. RSSB stocks global stocks and bonds. RSBT does bonds and trend. And there's a growing menu of stack with carry, gold and Bitcoin, merger arbitrage, international stocks, etc. Then, lesser known, but in my opinion better built, there's WisdomTree's Efficient Core suite, which many of you may already know about. NTSX is the more famous one. For every dollar you get 90 cents of stocks and 60 cents of treasuries, the classic 90-60. Well, 60-40, but leveraged a bit. They extend it internationally with NTSI and NTSE, and into gold with GDE and GDMN. Here's the key point. WisdomTree calls it capital efficiency. The return stack folks call it return stacking. In fact, I think they actually tried to apply for a trademark on that phrase, even though it's been used for about 50 years. But anyway, pop the hood and look underneath, and it's the same machine. Core exposure plus an overlay funded with a modest embedded layer of leverage. Which brings us to the uncomfortable question every thoughtful investor should be asking right now. If the phrase stack a return on top of your beta sounds clever and new, it isn't. Institutions did exactly this in the 2000s under a different name, Portable Alpha. And the question every investor should be asking is return stacking just the most recent iteration of this portable alpha strategy? The recipe looks awfully familiar. You get your market exposure, your beta, synthetically through swaps or futures, which is cheap and barely uses any capital. That frees up your actual cash to go hunting for quote-unquote alpha and a separate engine. Hedge funds, market neutral books, and a lot of fixed income and credit relative value strategies. Then you port that alpha that you found on top of the index. On paper, it's beautiful. You get the S&P 500 plus a stream of returns that's supposedly uncorrelated to it. Pension funds fell in love. Billions flowed in. And by the way, this is why a lot of private sectors don't have pension funds anymore. But that's another topic. It was the smart money trade of the mid-2000s. And then 2008 happened. The portable alpha became a cautionary tale that still makes allocators flinch to this day. So we have to ask, is return stacking just portable alpha in an ETF costume, waiting to blow up exactly the same way? Maybe. Some of it is, some of it isn't. And in my view, it's not even the main risk at play that I think investors should worry about here. Here's how the stack came apart in 2008, step by step. And it's important to understand because the failure points are exactly what we're going to test return stacking against. So, step one, equities crash. And the beta overlay, those swaps and futures, starts throwing off margin calls. You owe cash now. Step two, the alpha engine that was supposed to save you is also bleeding. A huge amount of that uncorrelated alpha was actually credit and relative value risk. And in a panic, every risky thing falls together. Correlations crush toward one. Step three, the killer. That alpha was parked in hedge funds with lockups and gates. So, right when you desperately need cash to meet the margin call, the door is bolted shut. Step four, you're forced to dump whatever you can sell at the absolute bottom. And step five, salt in the wound, funding market sees, London interbank offered rate spikes, and the leverage that felt free suddenly costs you a fortune. The portable alpha turned out to be a leverage bomb with an illiquidity fuse. In evaluating return stacking, let's be fair and start with what's genuinely the same, because they're pretending there's no resemblance that just wouldn't be honest. First, both are capital efficient. You're getting more than $1 of exposure per dollar invested. Second, both use derivatives leverage. Futures and swaps are doing the work in both cases. Third, both are sensitive to financing costs. That embedded cost of leverage rises and falls with short-term rates. So a high-rate world is a headwind for both. And fourth, this is the one people gloss over. Both have two-legged risk. You've got a core leg and an overlay leg. And there are absolutely environments where both legs lose money at the same time, which means your stacked returns are now stacked losses. So if anyone tells you return stacking is free diversification with no downside, walk away. It shares real DNA with a strategy that detonated catastrophically in 2008. But sharing DNA is not the same as sharing a fate. The differences are where it gets interesting. Now, here's the part where we can breathe a little bit easier. The thing that actually killed Portable Alpha in 2008 wasn't leverage by itself. It was a liquidity mismatch. Liquid margin calls colliding with illiquid gated alpha. And that specific failure is exactly what the ETF structure is designed to solve. Go down the list. Liquidity. The overlay isn't a hedge fund with a lockup. No, it's exchange-traded funds and treasury bills you can trade every single day if you want to. Leverage. Portable alpha programs could run 3, 4, 5 times or more, often opaquely. These ETFs run a defined, modest amount, roughly 2 to 1, and they're capped by the 1940 Act rules on how much risk they can take. Now, margin calls. This is huge. They hit the fund, not you. The collateral lives inside the fund. As an investor, your worst case is that the NAV fails, not that you get a cash call at the bottom. So you might experience a bigger dip, a bigger drop than most people, but it's not going to go to zero on you. Unless the financial system catastrophically fails, and then, well, we've all got bigger problems on our hands now, don't we? The overlay itself, instead of hidden credit beta masquerading as alpha, the classic stack uses trend following, which actually made money in 2008 and again in 2022. And it's all transparent, holdings posted daily, no black box. So same DNA here, but the fatal flaw got engineered out. Or did it? I never want you leaving a video thinking something is a free lunch or that there's no risks. There are always pros and cons to every strategy. This is leverage, full stop, and leverage cuts both ways. When things go against the stack, your drawdowns are bigger, not smaller. Both legs really can fall at the same time. 2022 is the perfect reminder. When the stocks and bonds went down together and a naive stock bond stack, well, that hurt. When cash rates are high, that embedded financing cost is genuine, grinding drag you have to overcome. The diversifier, say trend following, can go years underperforming and testing your patience. And the single biggest risk isn't any prospectus, it's you. It's the behavioral trap of buying the shiny leverage product after a great year and then panic selling it during its inevitable rough patch, locking in exactly the loss the new structure was supposed to help you avoid. So, return stacking should be respected as a tool, and it can genuinely improve a portfolio. Treat it as a magic return button, on the other hand, and the leverage will eventually teach you a very hard lesson. So how do you actually put this to work without getting burned? 4 rules. 1. Replace. Don't pile on. The smart move is to swap a slice of your existing core for a stacked fund. not to staple 2 times leverage onto a portfolio you're already fully invested in. 2, size it to your stomach. Never bite off more than you can chew, right? Because leverage amplifies the ride, positioning size matters more than ever. A little goes a long way. 3, know what you own. The overlay is the entire reason for doing this strategy, so actually understand the diversifier. Is it trend? Carry? Gold? And whether you believe in it, or if it looks strategic. And 4, judge it over full market cycles. Give a diversifier years to do its job, not one bad quarter before you rage quit. Return stacking isn't portable alpha reincarnated, not exactly. The liquidity trap that sank it in 2008 has been engineered out, but it's still leverage, and it still demands respect and patience. And above all, it demands moderation. The first thing a lot of people do when they first learn about return stacking is they go crazy with return stacking and immediately default to a 2x leveraged portfolio. One example would be RSSB. Is it necessarily a bad idea? I don't know. Is it necessarily the best idea? Probably not. Let's see how it compares to the total world market, the total US market, and the US Nader portfolio and implementation of one of the core 5 Miller momentum strategies of 50% value and 50% momentum. This time, US only equities. So, looking at how things pan out, we can see that RSSB it does reduce risk and you know, has a moderate effect on average drawdown compared to the total world market. The longest drawdown is actually longer than the total world market. It has a positive effect on volatility, at least. The Sharpe ratio is definitely improved. So it does a slight improvement, and I think that that's important to emphasize for borrowing against the entire value of your portfolio and basically having debt equal to your assets in your portfolio, you're able to eke out a little bit better of a risk profile. So, is it worth it? I'm not totally sure. As somebody who just went all in on the US stock market over the past 54 years, had better compound annual growth rate to RSSB, and that's including the years when the U.S. market was lagging. They had a, you know, slightly better average drawdown, a little bit longer longest drawdown, but a little bit better volatility. And it's interesting that the total world market's volatility is it's a little bit worse than RSSB, but RSSB offers greater returns and a little bit more drawdown protection, so that's why the Sharpe ratio is higher for it. But for the US stock market, the risk adjusted returns were actually better than RSSB. You know, not a big surprise due to massive US outperformance, but something to keep in mind. However, if you've gone with a factor investing approach and just combined 50/50 US large cap momentum and US small cap value, then you would have had a significantly higher growth rate overall with much better max drawdown than the world market or the US market, and comparable max drawdown to RSSB with better average drawdown control, a significantly reduced longer drawdown, or longest drawdown rather, less volatility than RSSB and comparable volatility to the world market and the US market, and a much improved Sharpe ratio with generally very favorable risk characteristics, including a lower ulcer index. So it would have been less likely to make you jump out. And what's really neat is looking at how the US Nader portfolio compares to RSSB, to the total world market and to the total US market over this time span, it's just way above them throughout its entire history, even during periods where the total world market was outperforming the US market, because you've got that extra diversification into US small cap, which isn't really represented in the S&P 500, and SPMO is doing its job of selecting the top quintile of the S&P 500 that happens to be performing the best in any given economic condition, with some lag, of course. But the bottom line here is, before diving into return stacking, the important question is, what are you trying to do? Because somebody who dipped into RSSB is likely saying, well, I want to have global stocks and matched against treasuries so that I can have drawdown protection. Well, I've just shown you that there's a factor investing approach that uses just equities that gives better returns and better risk adjusted returns. So in this case, according to the risk profile, the US Nader portfolio is on par in terms of its safety. In fact, it's a little bit more safe than RSSB over this period. So, if your goal was to achieve better risk adjusted returns and a better risk profile, then the all equity strategy beat out the return stack strategy here. So, the important thing is, I think it's a good principle to only return to return stacking if you can't find a way to do what you want to do without borrowing against your assets. Because if you can do what you want to do without going into debt, that's generally the better way to go. One also has to ask, especially if the return stacked product is using something that is not straightforward, like intermediate treasuries or gold, what strategy is the provider stacking? Well, that matters a lot. I made a video quite some time about the Dragon Rider portfolio, which is a 2x portfolio. Every fund is return stacked except for GDE, which is, actually 1.8x because it's 90% gold, 90% stocks. But anyway, in that, I modeled it using a combination of KMLM and DBMF on the back end to kind of simulate the sleeves of the managed futures portion. Well, return stacked on further study actually doesn't use the same SocGen index that DBMF does. They use the SocGen trend index, which is actually a more constrained sub-universe of the SocGen CTA index. And the trend index tends to be a little bit more controlled, a little bit more, well, smoothed out. It doesn't have other strategies combined into it like yield and carry. But the important thing is, it also doesn't have as high of a highs typically as the larger CTA index does. And that matters. So we can see on the left, we've got simulated tickers for historical purposes. On the right, we've got our normal RSSB, RSST, and RSIT. So we're modeling here a 60-40 global stacked portfolio where you've got RSSB 60% VT and 60% intermediate treasuries, mixed with a global stocks and 40%, but with a managed futures overlay also at 40%. So it's kind of a 60-40 inception portfolio, right? And one would expect this to really knock it out of the park. Now, going down here, we can see that in portfolio one is tracking a little bit above portfolio two so far. We don't have a lot of history, but this is good because we want to give this strategy an optimistic backtest, right? We want to see it at its strongest possible. So if these simulated tickers are beating the actual portfolio right now, then we know that they're actually overestimating what the returns would be in the past. And the correlation here is actually pretty good. I mean, it's 0.99. So we have high confidence that this back tested strategy is going to be okay. So we'll go ahead and compare it to the total US market, right? And let's see what happens. So I'm assuming that somebody pursuing this route is like, I want to have a diversified portfolio that's going to have at least a little bit more return. It's they want to see some significance there, right? So now the back test is complete, and we can see that. So first of all, it lost to the total U.S. market, but let's see what happened with the total world market, right? So total world market, hit the back test button again, and we wait for just a few seconds while that cooks. And here we go. Now, immediately, what's interesting is we've got our portfolio one, right? And it's doing okay in crises. But then when a bull market comes along and those borrowing costs really start eating into you and the trend index goes down, it's really interesting that the total world market just kind of catches up pretty quickly. I mean, you're looking at a compound annual growth rate difference of less than 1% and a money weighted return of just 0.44% between this return stack strategy and the total world market. So it doesn't seem like you're getting a lot out of that portfolio. Um, the Sharpe ratio is better than the total world market. I'll grant you that. But let's see how it compares to just Dimensional's total global portfolio, because we have a lot of deep history on that. So Dimensional's global equity portfolio, it's tilted according to the 5-factor model by Fama and French. So let's see how this 2 times leveraged portfolio deals with just a plain equity portfolio that uses factor investing. Well, interestingly enough, the factor investing portfolio that used equities only easily beats this 2x portfolio that stacks bonds and then the trend following strategy that's not the broader CTA index. So it's really important to note that Return Stack is not using the same index as DBMF. That makes a lot of difference here because Dimensional's plain Jane global equity portfolio beat out this 2x leveraged portfolio by a slight margin. It's got a little bit worse of a max drawdown, but its average drawdown is comparable. It's got a worse longer drawdown, but the volatility is much better. And the Sharpe ratio is much better. It's got much better risk adjusted returns. Um, so know what you're holding, know what you own. And that's why personally, I own just GDE from WisdomTree's lineup because the leverage is a little bit more modest uh, than Return Stacked offers. Also, their gold fund RSSX is a gold Bitcoin strategy, and Bitcoin is a deal breaker for me. So that's another matter. But the point is, personally, the only return stacked products that I've seen that I'm convinced are worthwhile for my own strategy um, would be GDE and perhaps GDT if I was pursuing something where I wanted less equity exposure and I wanted to rent my gold using TIPS bonds. The thing, though, is I'm not fully convinced yet that it's a good idea to stack bonds on stocks, at least not in the way that WisdomTree and Return Stacked have used them because they go for intermediate treasuries. And to overcome those borrowing costs, in my opinion, you'd want to at least go for um, long duration treasuries. You'd want to stack on TLT. Otherwise, I just don't think that it's worth the trouble. And after you factor in the overnight costs of borrowing and the Fed rate and such, I think it reduces to just stacking 100% cash on top of your portfolio once you take out all of the expenditure costs, which, I mean, maybe you want to do that, but as I just showed, there are pure factor investing strategies that only use equities that have better risk profiles than that and better rates of return. And I'll be frank, there are times when I wonder if I should be in GDE or if I should modify the Atlas portfolio and reduce my four current allocations from 25% down to 20%, tack on VFMO for a broad US momentum factor to complement AVGV, and then swap GDE for just a plain old Jane old gold fund, or maybe CEF if I want some silver. But there have been periods where just plain gold has outperformed GDE for almost 20 years consecutively. The reason being that, back in the 70s when interest rates really skyrocketed, the cost of borrowing gold on top of stocks just shot skyward so quickly that it ate into the benefit of holding gold. I'm not saying it got rid of all the benefit of it. No, it still really benefited from that, and you can see it from the shape of the curve on the chart I've got on screen. But um, it's kind of like, well, do I want the full protective power of gold during a real inflationary crisis, or do I want some of that protective power, but I want more returns during a market where the S&P 500 and gold are both going up, or at least gold is remaining flat? And the historical case would point to the latter, but it's not a conclusive thing. And it is something that I think about from time to time. Because if gold starts really shooting up very quickly and there is a constraint on the supply, then futures contracts become dislocated from the actual gold market, and something that tracks the spot price of gold and is backed by actual gold bullion like IAUM or GLDM is going to track, but the gold leg of GDE, since it's just futures, um, could kind of blow up, sort of like the 2008 situation, and just not trade at the full spot price of gold. So it is something that I think about from time to time. Anyway, thank you for watching Miller Momentum. If you enjoyed this video, don't forget to like and subscribe. What return stacking strategies do you use, if any? Let me know down in the comments. The next episode is going to be pretty cool. It's going to be a special portfolio workshop on a viewer's strategy. A huge thank you to AMG for reaching out. It's a really thoughtful construction, and I can't wait to get into it. It does use return stacking rather liberally, but I promise I didn't coordinate anything behind the scenes. This current video was already in the pipeline. I'm very grateful for all of you, and it's beyond cool that the channel's got over 500 subscribers now. Hey, spread the word. Let's keep rolling with Miller Momentum. I'll catch you next time.